What if the investment you believed was safe, predictable, almost automatic, suddenly made a move you didn't understand? No warning, no headlines screaming danger, just a quiet shift that could change your returns going forward. Right now, one of the most trusted dividend ETFs in the market has done exactly that, and most people haven't even realized what just happened. Because this isn't just a portfolio update. This is a moment that reveals how your safe investments actually work behind the scenes, and once you understand it, you might never look at dividend investing the same way again. The silent shakeup no one expected. Recently, Schwab U.S. Dividend Equity ETF made a massive change to its portfolio. It removed more than 20 companies and replaced them with a completely new set. Now, on the surface, that might sound routine. ETFs rebalance all the time. But this wasn't a small adjustment. This was a full-scale reshuffling. And here's the part that caught everyone off guard. The companies that were removed were performing well. Many of them were actually some of the strongest performers in the portfolio. Meanwhile, the companies that were added had been struggling. So naturally, investors began asking a simple but powerful question. Why would a fund sell its winners and replace them with underperformers? At first, it feels like a mistake, but the truth is far more interesting. The system behind the strategy, SCHD, is not managed like a typical investment fund. There's no portfolio manager sitting behind a desk making emotional decisions or trying to predict the future. Instead, it follows a strict, rules-based system. Specifically, it tracks the Dow Jones U.S. Dividend 100 Index, and that index determines everything. Which companies stay, which companies leave, and which new ones enter. It doesn't care about headlines. It doesn't care about recent hype. It doesn't even care if a stock has been performing incredibly well. All it cares about is the formula. The formula most investors don't understand. To be included in SCHD, a company must pass several strict filters. First, it needs a consistent history of paying dividends over many years. Then, it gets evaluated based on key financial metrics. Things like profitability, financial strength, dividend yield, and long-term dividend growth. Each company receives a score, and only the highest scoring companies make it into the fund. Everyone else gets removed. It's that simple. But here's where things start to get counterintuitive, because in this system, success can actually become a problem. When winning becomes a weakness, most investors believe that if a stock is performing well, it should stay in the portfolio. But SCHD doesn't work that way. When a stock's price rises quickly, its dividend yield naturally falls. That's because yield is calculated based on the dividend relative to the stock price. So as the price goes up, the yield goes down. And since yield is one of the factors in the formula, a lower yield can reduce a company's overall score, which means a strong performing stock can actually rank lower over time. And if it falls below the cutoff, it gets removed. So SCHD didn't sell its winners because they failed. It sold them because they became too successful for the system. The energy sector story that explains everything. To truly understand what happened, you have to look at one sector: energy. Over the past year, energy stocks experienced a powerful surge. SCHD leaned into that trend heavily, increasing its exposure significantly. And it worked. Energy became one of the biggest drivers of the fund's performance. Companies like Valero Energy saw strong gains. Investors benefited. Returns looked impressive. But then, something unexpected happened. As those stocks rose, their dividend yields dropped, and as their yields dropped, their rankings within the SCHD system declined. Eventually, many of them no longer qualified. So the fund began reducing its exposure. Billions of dollars rotated out of energy, not because the companies were weak, but because the math changed. Why this feels so personal? If you're invested in SCHD, this isn't just theory, it directly impacts your portfolio. Because the stocks that helped drive recent gains are no longer there, and the new stocks replacing them haven't proven themselves yet. So it creates a sense of uncertainty. You start questioning everything. Did the fund sell too early? Is it missing future upside? Should you stay invested or move your money elsewhere? These are real concerns, and they highlight something deeper about investing. The two mindsets dividing investors. Right now, investors are split into two groups. One group is cautious. They're sitting on the sidelines, holding safer assets like government bonds, earning steady returns while waiting for clarity. The other group is already invested. They're holding SCHD and trying to decide whether to trust the process or react to what just happened. And both perspectives make sense. Because what you're really deciding is this: do you trust the system, or do you trust your instincts? The bond comparison that changes everything. At the moment, the comparison between SCHD and bonds has become more important than ever. Government bonds are offering competitive yields, in some cases even higher than SCHD, and they come with significantly lower risk. So for new investors, the choice becomes difficult. Why take on market volatility for a lower starting yield? Why not wait? And that's exactly what many people are doing. But this is where most investors miss the bigger picture: the power of long-term compounding. SCHD is not designed to win in the short term. It's designed to build wealth over time. And this is where the real magic happens. When you reinvest dividends, your investment grows. As your investment grows, your income grows with it. Even if the yield percentage stays similar, the actual dollar amount increases significantly. Over time, this creates a compounding effect that can transform your portfolio. This is something bonds cannot replicate. Because bonds don't grow your base investment in the same way. They provide stability, but not expansion. What SCHD is really doing right now, the recent changes may feel uncomfortable, but they are actually a reflection of discipline. SCHD is not chasing past winners, it's repositioning for the future. It removed companies that no longer scored highly and replaced them with ones that currently meet its criteria. This is exactly what the system is designed to do. It adapts, it evolves, it resets, and that constant adjustment is what keeps it relevant over time. The risk that still exists. Of course, no system is perfect. There is always risk. If energy stocks continue to rise in the short term, SCHD could miss out on those gains, and that could affect performance. But if the energy sector slows down or corrects, the new portfolio could outperform. This is the trade-off: short-term uncertainty for long-term positioning. The bigger lesson hidden in all of this, what this situation really teaches us, is something bigger than SCHD itself. It shows how investing systems work. They are not emotional. They don't chase trends. They follow rules. And sometimes those rules lead to decisions that feel uncomfortable, but those decisions are often based on logic, not fear. And understanding that difference is what separates informed investors from reactive ones. The truth most people miss: SCHD hasn't failed, it hasn't broken, and it hasn't suddenly become risky. It has simply revealed how it truly operates. A rules-based system that prioritizes quality, consistency, and long-term performance. Even if that means selling winners. Even if that means making moves that don't feel right in the moment. Because in the world of investing, what feels uncomfortable today is often what leads to success tomorrow. If this opened your eyes and changed how you think about dividend investing, make sure to subscribe to the channel, like the video, share it with someone who believes ETFs are always simple, and tell me in the comments, would you trust the system or trust your gut? And if you want to understand where the next big opportunities are hiding, watch the next video. Because the market is shifting and the smartest investors are already one step ahead.